Section 5:2 Introduction to Alpha. 5.2 Alpha Analysis of Investment Strategies. Evaluating the alpha of different investment strategies, such as value investing or momentum investing, involves assessing their ability to consistently generate excess returns relative to an appropriate benchmark. Here's a general approach to evaluating alpha in different investment strategies. Define the strategy. Clearly define the investment strategy under consideration, such as value investing or momentum investing. Understand the underlying principles, criteria, or rules that guide the strategy's investment decisions. Select a benchmark. Choose an appropriate benchmark that represents the strategy's target market or asset class. The benchmark should closely reflect the strategy's risk and return characteristics. Common benchmarks for equity strategies include broad market indices like the S&P 500 or specific sector indices. Calculate alpha. Calculate the alpha of the investment strategy by comparing its performance against the selected benchmark. Alpha represents the strategy's excess return, above or below the benchmark's return, after accounting for the systematic risk captured by the benchmark. The calculation typically involves regression analysis or other quantitative methods. Assess alpha significance. Evaluate the statistical significance of the calculated alpha. Determine whether the alpha is statistically different from zero, indicating a potential skill in generating excess returns. Statistical techniques, such as t-tests or p-values, can help assess the significance of the alpha. Consider risk-adjusted performance. Evaluate the strategy's risk-adjusted performance in addition to alpha. Risk-adjusted measures, such as the Sharpe ratio, Sortino ratio, or information ratio, assess the strategy's ability to generate excess returns relative to the level of risk taken. A positive alpha alone does not guarantee superior risk-adjusted performance. Analyze consistency and persistence. Assess the consistency and persistence of the strategy's alpha over time. Evaluate the strategy's performance across different market cycles, economic environments, and time horizons. Look for evidence of sustained alpha generation rather than relying solely on short-term results. Compare to peers and benchmarks. Compare the alpha of the investment strategy to other strategies within the same investment style or asset class. This comparison helps assess whether the strategy's alpha is unique or if it is similar to what other investors in the same space are achieving. Evaluate how the strategy's alpha compares to alternative investment opportunities. Consider qualitative factors. In addition to quantitative analysis, consider qualitative factors that may impact the strategy's alpha, such as the manager's experience, expertise, and track record. Qualitative assessments help gauge the credibility and competence of the strategy's implementation. It's important to note that the evaluation of alpha in different investment strategies is not a one-size-fits-all approach. Each strategy may have its own unique characteristics and factors to consider. Additionally, the evaluation should be done with a comprehensive understanding of the strategy, considering its limitations, risks, and potential biases. Alpha analysis plays a crucial role in informing investment decision-making by providing insights into the potential value that an investment or investment manager adds to a portfolio. Here are some ways in which alpha analysis can inform investment decisions. Performance evaluation. Alpha analysis helps assess the performance of an investment or investment manager relative to a benchmark. Positive alpha indicates that the investment or manager has generated excess returns beyond what would be expected from exposure to systematic risk. This information allows investors to evaluate whether the investment or manager has delivered value-added performance. Identifying skill. A positive and statistically significant alpha suggests the presence of skill in investment decision-making or portfolio management. It implies that the investment manager has been able to consistently identify undervalued securities, exploit market inefficiencies, or time market trends effectively. This information is valuable when selecting investment managers or strategies with a higher likelihood of generating consistent excess returns. Strategy comparison. Alpha analysis enables the comparison of different investment strategies or approaches. By evaluating the alpha of various strategies, investors can assess their potential for generating excess returns and select strategies that align with their investment objectives, risk tolerance, and market expectations. It helps identify strategies that have historically outperformed the benchmark and may continue to do so in the future. Risk-adjusted return assessment. alpha analysis, along with risk-adjusted performance measures such as the Sharpe ratio or information ratio. Provides insights into the risk-adjusted returns generated by an investment or strategy. It helps investors assess the trade-off between risk and return and determine whether the excess returns are commensurate with the level of risk taken. This information is crucial for constructing portfolios that balance return objectives with risk management considerations. Portfolio construction. Alpha analysis aids in portfolio construction by incorporating investments or strategies with positive alpha values. Investments or strategies that have demonstrated the ability to generate excess returns can be given greater weightage in the portfolio. By including assets or managers with positive alpha, investors seek to enhance the overall returns and potential for outperformance of the portfolio. Manager selection and monitoring. Alpha analysis is instrumental in selecting and monitoring investment managers. It helps investors identify managers who have consistently demonstrated skill in generating excess returns and distinguish them from managers who may have achieved alpha through luck or random chance. Ongoing alpha analysis allows for the assessment of manager performance over time and informs decisions regarding the allocation of capital to different managers. Strategy validation. Alpha analysis validates the effectiveness of investment strategies by quantifying their ability to generate excess returns. If an investment strategy aligns with a positive and significant alpha, it provides support for the strategy's potential success. This analysis assists in the validation of investment theses and helps investors make informed decisions regarding the adoption or continuation of specific strategies. In summary, alpha analysis provides valuable information for investment decision-making by evaluating investment performance, identifying skill, comparing strategies, assessing risk-adjusted returns, aiding portfolio construction, facilitating manager selection and monitoring, and validating investment strategies. It enables investors to make more informed decisions and construct portfolios that have the potential to outperform the market.